My next guest is an expert fund manager and an astute market watcher. He's our guru on Aussie companies, taking a little reprieve from the cut and thrust and enjoying instead some time in the garden.
I started the business in my bedroom, actually. I left many years ago. I was working at Merrill Lynch, and then prior to that at most of the big investment banks. I decided I wanted to go out on my own, and so I started from very humble beginnings and built the business up. Subsequently sold it to a listed, well, I floated it. I floated the listed investment company, sold that business to, and the management rights to that company to another listed company, worked there for a few years and decided I'll take my gardening leave early and start again at some point. But I'm out of all that now, and I'm happy tending the garden at the moment, as it were.
Well, it's an interesting time to be tending the garden, isn't it? Because, you know, this bounce we got from March 6, we've talked over the years.
Sure.
It was a very worrying scenario, particularly before Christmas and the New Year, wasn't it?
September was the real problem. Lehman Brothers was, if you like, let go, and they collapsed. And the other thing that happened, of course, was the Senate failed to vote. I remember the day they didn't vote through. They didn't pass the bill, the first financial rescue.
That was around October 11, wasn't it?
It wasn't far away from it. And in fact, what happened is the Dow Jones was down over 500 points, and it was a terrible day. But I remember reminding or warning my clients, perhaps a year before that at some point in 2008 we would wake up and the Dow Jones would be down over 500 points. And the reason, there's no genius in that. All I saw was a rapid increase in the number of subprime mortgages that were going to be reset. And in fact, there's an even bigger number of alternative A and option type mortgages, adjustable rate mortgages that are going to be reset in 2010 and 2011. Not many people are talking about that at the moment. At the moment, law looks very good.
Do you think it could be triggers for a market fall again?
Look, I'm no good, Peter, and I've said this to you many, many times. You know, I'm no good at predicting the market. And here's the interesting thing. I don't think you need to be able to predict the market accurately to be successful investing in it. The key is to be able to value businesses, and once you've valued those businesses, to simply wait until prices are below the value. And that's what all investing is. It's simply buying something for less than what it's actually worth.
Okay, but this then opens up an interesting issue, because I know around March, when the market hit, you know, it's low, you weren't ringing me up and saying, "Switch, get into the market." But what were you doing? Were you looking at companies like, because I was forced to actually reporting on radio and television, people would ask me, I said, well, I don't know what companies are bad, but I suspect Westpac and CommBank look great at these prices. Sure. So were you actually putting the Montgomery fortune on the line there?
Yeah, we did. I did. In fact, the last thing I bought was in February. February or March, can't remember now, but around that time, and it was a company called Fleetwood, which was the second largest manufacturer of caravans in Australia and one of the largest suppliers of portable accommodation for mine sites in Western Australia. And it was trading on a 30% grossed up dividend yield. It was trading at somewhere around $3.20 or thereabouts. And I remember buying that not only for the funds but personally as well. And it is $6.70 or $6.80 now. That was the time to buy. Now, Peter, please don't be offended. I didn't ring you, but
I am offended. You should have given me that tip on Fleetwood.
I'm sorry, but I did have some other hosts ring me, and I did go on their show, and I did say it was cheap, and I did say, I think my exact words were, we will look back on this period as one of rare opportunity, and in fact that's what's transpired.
Okay. Now, part of the way you invest, and this is something I'd love to share with our viewers, is that you've been affected by, who was that famous American value? It was who Warren Buffett was inspired by?
Yeah, Benjamin Graham.
Benjamin Graham.
That's right.
Okay. Now, why don't you tell us what Graham advice is about buying companies?
A lot of people hear about Benjamin Graham or read about Benjamin Graham. They go out and buy his books and they try and replicate what he's done. I suspect if Benjamin Graham had access to a computer, he probably wouldn't have reached some of the conclusions that he reached. But he did give us, and Warren Buffett he gave as well, some really pithy little reminders of how to invest successfully. One of them was to think about the market in terms of businesses rather than in terms of stocks. What a lot of people do is they trade stocks instead of buying businesses. So think about businesses rather than stocks. That's the first thing. The other thing he gave us was something, an allegory called Mr. Market. He basically said, you should think of the market as this manic, depressive or very emotional being who is a partner with you in a business, and every day he knocks on your office door and says, look, I'm willing to buy your share of the business and I'm willing to sell you my share of the business. And what you need to understand is that he's almost bipolar in his approach to the stock market. One day he's enthusiastic about the future, and the next day is completely depressed.
We've all met people like that.
Yeah, exactly. Well, the stock market is not unlike that particular business partner, and so our job is to take advantage of his moods rather than listen to his wisdom. And there are a couple of things, and I think the third thing, and probably distilling all of Benjamin Graham into 3 words, the 3 most important words were margin of safety. And the idea is that you buy businesses below what they're worth with a large margin of safety. And valuing a business isn't that hard. There's a whole lot of esoteric arithmetic around this, but none of that needs to be, you don't need to think about that. The maths is very, very simple. In fact, Warren Buffett gave us a formula in 1981, which is a really useful starting point for valuing companies.
Share it with us.
Well, it's return on equity, the return on equity of a business that you expect the business to produce on average over a medium time frame, divided by the required return, multiplied by the equity per share. And that's the formula, that's the basic formula for a company where a company pays out most of its earnings as a dividend. That's going to approximate the intrinsic value of the business. So if you've got a business that's generating a 20% return on equity and you want a 10% return and it's got $1 of equity, well, 20 divided by 10 is 2. 2 minus the $1 of equity is $2. So you'd be prepared to pay $2 for every dollar of that equity. Now, as simple as that is, it would have told you that Wesfarmers paid too much for Coles. It would have told you that Foster's paid too much for South Corp. It would have told you that ABC Learning Centres at $8 was way overpriced. So a very basic piece of arithmetic that is very, very effective. And essentially that's all Warren Buffett's been using. That's what I use and a number of other...